Hello people, this is Dr. Wang here recording. Now we're moving to chapter 11, the cash flow estimation or risk analysis. And this is still within the unifying theme of a capital budgeting module in your Canvas. So we have covered chapter 10, which is about the basic criteria to judge the success of capital budgeting projects. And then in chapter 11, we're going to deal with the cash flows to do the calculations and also the risk analysis. And then in chapter 17, we're going to learn the international part of a capital budgeting. So this chapter, first, we're going to focus on the cash flows. So what cash flows are relevant? Some of the cash flows are actually not relevant, like the sunk cost, like the financial cash flows. And some of them are relevant, like the opportunity cost, even though it's not really happening, but still we need to consider that. And also taxes would be relevant. In the capital budgeting, working capital needs to be there. If you are running a restaurant, you definitely need inventories, raw materials to process the food, and that kind of cost money. And this would incur cash flows. And for the risk analysis part of this chapter, we're going to learn sensitivity analysis, scenario analysis, and a simulation analysis. The simulation analysis here is basically scenario analysis, but it incorporates so many scenarios. And our focus here would be developing all the cash flows in the NPV formula. And this formula has been exposed many times before. And in chapter 11, we deal with cash flows. And in chapter 9, we deal with the discount rate or the weighted average cost of capital. All right. Here we have a project. Let's say this project lasts for 4 years, and the initial cost to buy the equipment is $200,000 plus $10,000 shipping cost plus $30,000 installation cost. If you are calculating the depreciation of this equipment, not only you need to use the initial cost of it, the $200,000, but also you need to add the shipping and installation cost as a depreciation base. What will be the depreciation method? You are going to use a modified accelerated cost recovery system method. And in particular, you're going to treat this equipment as a 3-year assets. All right. And also, we need to incorporate inflation in our analysis. The salvage value of this project would be $25,000. This basically is telling you after 4 years of its life of this $200,000 machine, it will be fully depleted at the book value, but at the market value, it would be sold for $25,000. You see, on the book value, it will become zero because you have a 3-year depreciation method plus another year, which would deplete all the remaining book value down to zero. But still, the machine is there. You can sell it for a scratch, and that would earn you $25,000. So this is the market value, and for the book value after 4 years, it's zero. Here is more data. The annual sales is 1,250 for each unit, and the unit price is $200 at the year 1. And you should know that inflation is at 3%, and we cannot ignore inflation, especially right now. When you go to the supermarket, everything's price just went up, and if you buy services, the price was also higher than before. The unit cost is $100 here, and you also have net working capital. Well, if you're thinking that working capital is too abstract, just think it as an inventory, all right? So if you want to make some sales, you need to maintain some inventory in advance. If you want $100 sales, then you need to have a $12 worth of inventory. And in this case, the percentage is 12%. Tax rate is 40%, and the cost of capital is 10%. When we calculate the cash flows, we should use incremental cash flow, which is the cash flow with the project minus the cash flow without the project. Well, this project starts from a scratch. It's a brand new project, meaning you have no old project to abandon. This is not a replacement of an old project. So we just focus on the cash flows brought by the new project. if there is an old project, then we will need to subtract the cash flow from the old project due to the replacement. All right. So, but here you just keep that in mind. You would need to minus the corporate cash flow without a project. And right here, since we start from a scratch, so the cash flow without a project would be zero. But if there's an old project you are replacing and it generated some cash flows, you need to subtract the old cash flows from your calculation. Okay. So how do you treat the financial cost? Well, the company pay interest to the debt holders, pay dividends to the stockholders, and these are all solid cash flows. But in the capital budgeting, we do not incorporate all these cash flows as part of the free cash flow because we have incorporated those dividends, those interest expenses already in the WACC calculation. Back to this formula, you will see this R here. From chapter 9, it depends on capital structure. It also depends on cost of equity and the cost of debt. The interest would be cost of debt, and the dividend or the price or stock price return would be cost of equity. So they are already incorporated in the discount rate. Therefore, we do not need to put the dividends and the interest in the cash flows again. So financial cash flows would not be part of your cash flow. Just remember that. And also sunk cost is not part of our formula. If the company spent 100 grand last year trying to improve the production line set because this happened before the project start, before year zero. When we do the capital budgeting, our very first year cash flow should be cash flow zero, not cash flow -1. So any cash flows like this $100,000 occurred before cash flow zero, before today, would be called a sunk cost, and that's not part of the free cash flow. Okay, and when we are calculating the depreciation base, as I mentioned earlier, we not only need to include the cost of the equipment, but also the shipping and installation cost. Cost here is 200,000, shipping fee is 10,000, installation is 30, so that together give you 240,000. And for the MACRS depreciation method, here are the table given by the IRS. These are all percentages, and this would be the percentage of depreciation for each year. It gives you 4 years of depreciation for your 3-year assets. As you can see, all of the 4 percentages would add up to 100%. So that means for this 3-year assets, if you use it for 4 years, then at the end, all of it will be depreciated. Then you will have a 0% value left. And if you use the machine for 3 years only, then after 3 years, you will have a 7.41% value left at the ending book value. If you use the machine for only 2 years, then what will be the remaining value after 2 years? You will have a 14.81% plus 7.41%, about 22% left for the ending book value after 2 years, not 3 years or 4 years, after 2 years. Okay, so you're going to use the depreciation basis multiplied by each of this percentage to get the dollar amount of depreciation. This method is called a modified accelerated cost recovery system. The way it's called accelerated because in the second year, as you can see, the speed of depreciation get accelerated. In the first year, it's only 1/3. In the second year, it's more than 1/3. And the second year involves an acceleration depreciation, which gives you higher depreciation rate than all the other years. And the units for year 1 all the way to year 4 will stay the same, but the price increase with inflation as well as the cost. The inflation amount is 3%, as we mentioned earlier. So do we need to consider the inflation? Definitely yes. When the price increase, that would affect your revenue. It would also affect your cost of goods sold. Would that affect your cost of capital? Actually, yes. So you would have a real term cost of capital, a real R. The small r actually is the discount rate, is the WACC, or the cost of capital. The one you get here is a nominal R. It includes both inflation and the real rate. When you're using the nominal rate, which is a 10% given to you, then you should know that inflation is incorporated in your cost of capital. That means for your cash flow calculation, you should also incorporate inflation. If you just use the real cash flow, meaning you take away the effect of inflation, but you use the nominal cost of capital, which includes the inflation, then your NPV would be too low because your numerators are too small since you take away the inflation, you take away the compounding effect of inflation. And your denominator, the discount rate, includes the inflation. It gets larger than the nominal one, and that makes your final value too low. Okay, so bottom line here is to incorporate inflation in your cash flows. Okay, and here would be the calculation of operating cash flows, which would be a very important part. So let me move all of this in Excel. So let's say the total cost of the equipment is $240,000. Okay, and you have 4 years of an investment, 1, 2, 3, 4, and the unit each year is 1,250, and the price each year at the beginning of year 1 is 200, and you know that your inflation 3%. So you're gonna use each of the previous price multiplied by 1 plus the 3% locked. All right, and then just to drag it all the way. And for the cost per unit, you start with 100, and of course we're gonna use each of the previous cost multiplied by 1 plus the inflation, lock it of course, then drag it all the way. Okay, so what you would have here, you can calculate the sales, which is the price times the unit, and you can also calculate the cost of goods sold, cost of goods sold, which is the cost per unit times the total number of units. All right, and what would give you here is a gross margin, which is the total revenue minus the cost of goods sold. It is the variable cost. Okay, so the next one you're going to deduct is depreciation. When we calculate depreciation, we're going to borrow the IRS table, and here are my percentage. I will borrow this. I will borrow these numbers and copy, and then paste special, transpose it, and make them having the same format. Okay, and these are all percentage. Okay, so when I calculate each depreciation for each year, then I will use the depreciation basis, which is up there, log it, multiplied by each of the depreciation percentage. So this is in dollars, and all this would be in dollars. Okay, and then I would end up with EBIT, which is the operating profit. So I use the gross margin minus the depreciation expenses There's no fixed cost. There's no selling administrative expenses. So there's no fixed cost. But in some other cases, I would give you fixed expenses. Okay, the next thing we do is taxes. And we know that taxes is generated based on the operating profit. And the tax rate, as indicated above, is 40%. And I need to lock that. All right, hit F4 to lock the tax rate because I'm gonna drag it, and I don't want the tax number to shift. And then I select this EBIT, then drag it all the way to the right. Decrease decimals. So these are my taxes. The next one would be net income. You see, this net income is different from net income on the income statement because it does not incorporate interest. Well, after you get the operating income, you should deduct the interest in your income statement. But if we are analyzing free cash flow, interest is not part of the free cash flow. We do not consider that. Okay, so just to do the deduction here, net income, and then drag it. Then very last one is operating cash flow. The operating cash flow basically is the net income excluding interest expenses plus the depreciation expense. Right here we have the depreciation, which is a non-cash term, and we are analyzing cash flows here. So if we have deducted some non-cash term before, then we need to add it back to cancel the non-cash effect. So net income plus depreciation, then you drag it all the way. And now we have this operating cash flow, which occurs on an annual basis. And the operating cash flow, it is just one of the four major components of capital budgeting. You also need to solve for the capital expenditure, which is the lump sum money you spend. Let me just put it here, capital expenditure. And this occurs in year 0, and that's the total cost of the machine. So let me just borrow there, and it is a negative cash flow, so put a negative sign in front of it. Okay. All right, and here we have another important component. It's called a change in net working capital. Well, net working capital always is a percentage of the sales. The net working capital is 12% of the sales in the next year. You see, this is net working capital at year T. This is the sales at T plus 1. And it is a pretty intuitive. If you want to make some sales, making some products, so in the next period, you have to produce it beforehand, and you have to maintain that inventory beforehand. So you really need to maintain certain level of inventory or cash, any assets related to your short-term operations. So this would fall into the category of net working capital. So what I'm going to do here is first get my net working capital solved, and it is 12% of the sales in the next year. So the sales would be already calculated, and then just to drag it, and in the last year my net working capital would be liquidated to 0 because after 4 years this entire project is gone and I don't need to maintain any inventory henceforth. But net working capital is not the final item I'm looking for. I'm looking for the cash flow effect from the change of net working capital. All right, and this is a very delicate term. When your net working capital change, then you would spend cash for it. If your net working capital increase, like you build more raw materials in your warehouse, then you would need to spend cash for it, then your cash would go lower. So when net working capital goes up, your cash would go down. And for year 0, when you have net working capital increase from a zero, from a scratch, all the way to $30,000, then your your cash effect from this change of net working capital is a negative 30,000. So I'm going to use 0 minus negative 30. All right. So that means I will need to spend a $30,000 cash to build this inventory from 0. All right. And then in the next year, I made more sales. Then I will need to have a larger inventory, and my inventory increases from the last year's level. And that gonna require me to spend more cash for the incremental amount of inventory. So how much cash do I spend? I spend $900, and that $900 come from this is 30,000 minus 3,900. So I spent another $900 to build up the inventory from a 30,000 to 30,900, and then I can just drag it all the way. As you can see, in the next year, my inventory still increases. That makes me spend more cash to enlarge my warehouse. It happens in the third year, but in the fourth year, it is an exception. You will see that the entire project is gone. All the inventory needs to be liquidated, just like what happens with the Toys R Us, with the Kmart or Hobo. These are famous stores in our neighborhood. When they close the store, they have to liquidate all their inventories, all their goods productions. And what would happen to the cash? Of course, they're going to receive cash from the liquidation. So at the very last, you're going to receive a lump sum amount of cash from liquidation of inventory. And this component is called a change in net working capital on the capital budgeting table. However, you guys should know that it is really the cash effect from the change of net working capital. All right, but the official name is a change of net working capital. Alrighty, and the last one is the salvage value. So for the salvage cash flow, it is the machine residual price at the market level. So after 4 years, you're gonna sell off the machine, and you need to know how much you would receive from the machine. And also, you need to pay capital against taxes if the market price you sold the machine at is higher than the book value of the machine. In our depreciation, as you can see, from year 1 all the way to year 4, it's completely depleted all its value. So if I add all of this together, it is 100%. So that means there's 0% book value left after 4 years for this 3-year machine. So the ending book value is 0. However, based on the given information, you can still sell the machine at $25,000. All right. So let's just put it here. Salvage value is 25,000. Okay, and your salvage cash flow includes 2 components. One is the salvage cash flow. It's just the money you receive from selling the machine. That's one of them. Make it dollar. Decrease decimal. And another I need to add in here, actually I need to deduct here, is called capital gains tax. You are going to use the 40% tax rate, okay, multiplied by whatever the capital gains you make. So when you sell the machine, you get a $25,000, and what is really worth on the book, it is worth 0. All right. So you're gonna pay capital gains tax for it. And sometimes we have a non-zero ending book value. Actually, for most of the cases, if your ending book value is $24,000 and you sell the machine for $25,000, then you're only paying the tax on this extra $1,000 instead of the whole $25,000. And if your ending book value is $20,000, then you just pay taxes on the $5,000 gap. All right, and here is a very different case. Your book value is 0, so you pay taxes on the entire salvage value. Okay, so here is your salvage cash flow. So far, I have focused on 4 components. One is operating cash flow, another is capital expenditure, then change in net working capital, and then salvage cash flow. The very last one is a free cash flow I'm looking at. Okay, it is the summation of all the four components. One component is here, one component is here. Although it's missing, I still need to incorporate this cell, and then change in net working capital, then salvage cash flow. So I just simply add the four components together to get my free cash flow, and then I just drag it all the way. So this would be the cash flow based on which we conduct capital budgeting analysis, based on which we calculate the internal rate of return, payback period, and above all, net present value. So right here, it tells you the cost of capital is 10%. So cost of capital is 10%. And I will use this 10% as a discount rate to solve for the project NPV. It is NPV, then 10%. I select all of this future cash flows and then add cash flow 0 outside the NPV box. Okay, so this is my NPV for the project. And for IRR, it is pretty straightforward. You just use the IRR function and select all the cash flows at once. And the 24% is definitely higher than the 10% of cost of capital. That means you can get more return from the project than the money you pay to finance the project. So you are making money. And for the modified IRR, I have introduced before, you don't have to remember the mathematical formula. You just need to use the MIRR function, and you put all the values first, and then the finance rate is 10%. That's your cost of capital. And we also assume when we reinvest the cash flow we make from year 1 to year 3, we can make another 10% return. All right, actually just a 10% return. Okay, so this is your modified IRR. And for the profitability index, you're gonna use the NPV 10% discount rate, all future cash flows, divided by the cash flow 0. And we should know that cash flow 0 is a negative, and we're gonna take the absolute value of this ratio. Okay, and it's 1.33. It's greater than 1, so that means the money you make is more than the money you spend. So that's a good sign. And for the payback period, this requires a little more work, definitely. You need to get the cumulative free cash flow. Let me just insert another row here. So the cumulative in year 0, it is just itself, and in year 1, you just add the money you make in year 1 to the remaining balance of last year, or the beginning balance of this year is the same. And then you just drag it all the way. Okay, as you can see, after 1, 2, this is year 0. After 2 years, your money get paid back. So how do you get that? It is 2 plus the remaining balance at the beginning of the 3rd year divided by the money you made in the 3rd year. And you know the ratio is negative, so you need to take the absolute value of it. So this is your payback period. It basically is telling you it's going to take 2.5 years to get your money back. All right, and to get a discounted payback period, it is a little bit more complicated, which requires you to get the discounted cash flows and accumulated discounted cash flows. So let's just put a discounted cash flow. So for each year, I will use the free cash flow divided by 1 plus 10% raised to the power of the year number. If the year number is 0, so there's no discounting effect. But if it's year 1 to year 4, there will be a discount at different levels. Okay, as you can see, these are the exponents according to the year number. Alrighty, then I can calculate the cumulative discount cash flow, and I will use year zero's cash to start with, and then the next year the accumulated discount cash flow is the discounted cash flow I made plus the remaining balance from last year, and then I just drag it all the way. As you can see, after the third year, in the fourth year, my remaining balance turned out to be positive. So that's where I started running a surplus from a deficit. So for the discounted payback, it should be 3 because after 3 years, my balance turned out to be positive. And once again, I need to use the absolute value for the ratio, and that ratio is the remaining balance, okay, divided by the money you make in this year, and all at discounted level, of course. So this would be your discounted payback. Because you discount all the future cash flows, so for each $1 or $100 in the future, it is worth less than $1 or $100 today. So their canceling effect becomes weaker. So that's why it takes longer for you to pay back your initial investment.